Hi everyone, welcome to RHB Bank's podcast series. I'm Nova Lui, Head of Investors Advisory. With the continuous rate hike cycle from US Fed Reserve, Bank Negara Malaysia followed the rate hike path but at slower pace by raising the overnight policy rate OPR to curb rising inflationary pressure and to strengthen the ringgit. Today we have Fakri, RHB Group's Head of Fixed Income Strategy, to share his views and comments on Malaysia interest rate environment as well as the fixed income market outlook going forward. Hi Fakri, thank you very much for joining our podcast today.
Hi Nova. Thanks for having me today, and I'll be happy to share our view on rates and the expectation of the bond market.
Okay, Fakri, on the 3rd of November, Bank Negara Malaysia announced 25 basis point rate hike, which is very much within the market expectation. However, the actual question is, how much more rate hike is expected by BNM moving forward? Is our house view in line with the general market consensus?
Well, our economist sees the overnight policy rate or OPR to reach 3 to 3.5% peak in 2023. Hence, as OPR is at 2.75% by year end, we see scope of another 25 to 75 basis points hike in the first half of 2023, or up to 3 hikes of 25 basis points each, as long as inflation continue to be on the high side. And from our observation in the ringgit government bond markets so far, the impact of OPR reaching 3.5% has been largely priced in. For example, MGS 10-year has tested 4.4% level earlier, which has fully priced in the OPR at 3.5% based on the 5-year historical median average spread of 90 basis points.
Okay. Bond price has dropped along with other risky assets such as equity. Traditionally, investors trust that bond will have negative correlation with equity. However, we have not seen the same so far for this year. This makes bond become more attractive. Is there a particular duration or credit rating that you prefer for investor who has an investment horizon of up to 3 years?
Well, Nova, we expect a total return from bonds to be better next year as prices are expected to stabilize and investors may enjoy a higher income accumulation from coupon and profit distribution. As central banks most likely to end the tightening cycle earliest by first half of 2023, in addition to declining inflation numbers, bond return should record positive returns in 2023. In terms of duration, investors may consider tactical positioning at the short to medium duration bonds maturing around 2-year to 5-year for an outright yield play, while taking a strategic positioning at the longer dated bonds such as 10-year or more to improve the overall return on investment of the portfolio. Well, for the rating, we prefer to stay put on the investment grade space and to look out for hybrid callable bonds from a high quality credits for yield pickup as well as for duration strategy as well.
Okay, Fakri, you mentioned that you prefer to stay on the investment grade space and to look out for hybrid callable bonds. And with the rising interest rate environment, banking or financial sector tend to benefit from higher interest rate. Recently, there are a few financial or bank bond paper issued. Can you share your insight to our investor on this sector?
Yes, Nova, banking sector have always been one of our key picks for this year for the bond portfolio as key beneficiaries of a higher interest rate environment and the recovery of the economic activities. And the instruments from this sector suits our liquidity, duration, as well as a yield strategy. We prefer the Tier 2 subordinated debt, which is ranked lower than the senior banking bonds, but higher than equity for decent yield pickup compared to the bank's fixed deposit rates. While for investors who are more adventurous, you may want to consider investing in the bank's hybrid capital or additional Tier 1 papers, which are ranked higher than the ordinary shares that are listed in Bursa in terms of payment priority with potential yield pickup relative to the dividend.
This comes to my last question. At this current juncture, is the bond yield for financial sector attractive enough? Shall I put in a layman term, is now a good time to invest into financial or banking related bond papers? Please share your thoughts to our investors.
Well, I believe that investors should start considering to allocate some of their investment portfolio into banking related bond papers at the back of the sector's strong fundamentals and our positive outlook, as well as, like I said, regular income generated from the semi-annual coupon and profit distribution. And secondly, we think that the banking bond papers are also highly liquid in the secondary markets, which means that investors has the exit plan as and when they want to liquidate their investment in the banking bonds.
Thank you very much for your sharing to our investors today. Dear investors, please get in touch with your RHB Bank's relationship manager if you want to know more of the potential fixed income solution that may fit your investment profile. Meanwhile, please visit RHB Merge website to view more of our other podcast series. Thank you very much for joining us today, Fakri. Goodbye and stay safe.